Welcome back, property investors. Have you ever found yourself in a situation where you're trying to buy an investment property using a DSCR loan? Now, the market rental analysis comes in a little lower than you expect, and now your loan's in jeopardy because your DSCR ratio is too low to qualify. If so, never fret. In this video, we're going to be giving you five different ways for you to improve your DSCR ratio so you can continue with your transaction. And be sure to stick around to the end because we're going to give you a bonus 6 alternative in case those first 5 don't work. Now, before we get started, if you're new to DSCR Loans, be sure to check out our other video. I'll include a link here. Now, that's really going to help you understand the fundamentals of this type of loan program. And number 2, for the channel, if you like this sort of content, be sure to like, comment, and subscribe to the channel. We really appreciate your support. Now, before we get into these 5 tips, just a quick housekeeping note. One of the things you really want to do is to get to know your lender. Contact your loan originator. Hopefully they're experienced with DSCR loan programs as we are, and they can help you understand the parameters of the loan specific to this transaction. Let me give you an example. For most DSCR loans, the ratio should ideally be at 1.0 or higher. However, for our DSCR loans, for instance, we allow DSCR ratios down to a 0.75 ratio for single unit properties. And of course, this could affect your final interest rate, LTV, and thus your down payment in the transaction. Now, having these conversations with your lender up front will give you a really good solid footing so that if something happens during the transaction, you'll know which way this ship is going to go during the transaction so you can purchase with confidence. So tip number 1, increase your down payment. This one seems pretty straightforward and a bit obvious. It can be a really powerful move depending upon how much cash you have access to and of course how much you're willing to budget for this transaction. A higher down payment reduces your loan amount, leading to a lower monthly payment. This lowers your debt and improves and increases your debt service coverage ratio. Moving on to tip number 2, consider reducing the premium cost for your DP3 or homeowner's insurance policy. This might help you cut down on the premium costs, thus, again, lowering your overall monthly expenses. For instance, if you're able to reduce your annual policy premium by $1,200, this equates to $100 a month, and that can really improve your debt service coverage ratio. Adjusting your insurance premium is a great way to do it, but you do need to have a good conversation with your insurance agent as well as your lender to make sure that the policy is both going to meet the minimum loan requirements, but also get you the minimum type of coverage you need for your own safety and protection. If the policy is in everything you want, you are always free to change your policy down the road. Now, tip number 3 is to purchase discount points to buy the interest rate of your new loan down. Yes, this option requires some upfront payment, but it is a strategic investment. A lower interest rate equates to lower monthly payments, which in turn improves your DSCR ratio. And this is a nice segue into tip number 4, which is to ask the seller to contribute a closing cost credit. Our DSCR programs, for instance, allow up to 4% of the purchase price in seller credits. And you can use this money towards the purchase of discount points, which can significantly improve your interest rate while reducing your own initial cash outlay to improve your DSCR ratio. And the best part is it didn't come out of your pocket. And finally, tip number 5, which is to renegotiate the sales price of the home down to meet the debt service. If you were transparent and you told them what type of loan program this was and your intention for that property as an investment, then they may understand. The object here is to have an honest conversation with the seller to kind of test the waters here and see how much they want to sell this property or they want to try to remarket. It depends upon how much you're looking for a sales price reduction. So if you contact your lender, we can tell you how much of a sales price reduction would get your debt service back in line, and then you can have the conversation with the seller. And now for the bonus tip. Now, the bonus tip is these 5 tips do not work, or some permutation or combination of these things doesn't work. Try asking your lender about a no-ratio DSCR loan. If you're not familiar with this option, it is essentially a DSCR loan like any other, except there's no debt service ratio calculation in the loan. It's essentially a credit score and a down payment for the most part, and of course the appraisal. But if your lender offers that option, that may be a great way for you to continue the transaction. If you want to learn more about no ratio DSCR loans, be sure to click the link in the description above and below so you can understand that as a great viable option to continue your transaction. And there you have it, 5 different ways to lower your debt service ratio as well as an option in case those first 5 don't work. If you're trying to work on your debt service ratio, I really want to make the recommendation you try out our one-of-a-kind free debt service coverage ratio or DSCR Calculator. Again, you can use this day or night, and you can run your numbers and really get in there and fine-tune that debt service ratio to make sure that your investment is a sound one. Now, if you're looking to invest in real estate using a DSCR program, we have a really diverse line of DSCR programs to meet almost any need. We lend in 29 states, and we have a ton of experience doing this loan program. Thanks again for watching. Happy investing. I'm Derek Bisson, and this is Unconventional Lending.